Handing a teenager their first bank card moves them from the role of a passive consumer into that of an active manager of assets. This initial setup dictates financial behaviors for decades. A precise configuration lays the tracks for long-term wealth, while a sloppy one traps the teenager in a cycle of chronic fee erosion before they even finish high school. The costs of failure are high. In 2025, U.S. households paid $12 billion in overdraft fees. Also, keeping funds in a non-interest checking account during inflation dissolves wealth daily. Finally, digital fraud targets this demographic through peer-to-peer scams, offering zero recourse. A solid financial foundation relies on a progressive ecosystem. The exact structure depends entirely on whether your teen has official, earned income. Treating a checking account like a savings account or using a savings account for daily transactions guarantees wealth erosion before adulthood even begins. Building this system requires balancing two opposing forces: the demand for high liquidity versus the necessity of wealth preservation. High liquidity provides the functionality needed for daily life, but it also creates exposure. It makes a teen's entire balance vulnerable to impulse spending and digital theft. Wealth preservation vehicles offer massive compounding advantages, but they thrive on behavioral friction. They require locking capital away to protect it from short-term desires. The market offers a confusing array of options, from basic youth savings to high-tech credit-building apps. The optimal strategy must balance these trade-offs against the teenager's specific age and income status. Selecting an account type based on a bank's marketing campaign is a flawed strategy. The tool must precisely match the teenager's current financial reality. This chart maps effort against growth. The first pillar is the savings account, enforcing mental accounting through withdrawal limits. It provides a safe harbor for emergency funds, yielding up to 5% APY, though sacrificing transactional velocity. The second pillar is the checking account, designed to receive direct deposits and facilitate daily debit card swipes. It provides functional independence, integrating teens into the digital workforce. However, this high liquidity increases vulnerability to overdraft fees and digital scams. Federal deposit insurance is the absolute baseline requirement for any account. This ensures the teenager's money remains protected in the event of an institutional collapse. Note that while FDIC covers bank failure, it offers no protection if a teen voluntarily sends money to a scammer via Zelle or Venmo. These two accounts are not competitors. A checking account manages the velocity of daily life, while a savings account manages the accumulation of long-term wealth. Our third pillar is the credit catalyst, using secured teen debit apps or adding a teen to a parent's credit card. This establishes a credit score before 18, drastically lowering future borrowing costs for car loans or apartment leases. Parents must actively sponsor the app or legally link the teenager to their own credit line. This requires hyper-vigilant oversight. Every purchase must be monitored to ensure the debt is managed responsibly. The risk is catastrophic. A single missed payment by the teenager destroys both the parents' and teen's credit profiles simultaneously. Building early credit is a powerful lever, but one that should only be pulled if the family has established absolute behavioral trust regarding debt. The fourth pillar is the Custodial Roth IRA, designed for generational wealth building. It provides decades of tax-free growth. A single $7,500 contribution at age 15 can mathematically compound to over $200,000 by retirement. Strict legal requirements apply here. The teenager must have documented official earned income from a W-2 job or tracked freelance work. Federal law dictates that allowances, cash gifts, and informal birthday money do not qualify as earned income for IRA contributions. The major trade-off is extreme illiquidity. Earnings are generally untouchable without heavy penalties until retirement age, requiring the teen to part with that capital today. If a teen has surplus official income not needed for immediate expenses, the Roth IRA is the most powerful financial tool available to them. For a young teen aged 13 to 15 who does not yet have an official job, the roadmap is clear. Open a joint high-yield savings account and automate allowance deposits directly into it. This introduces the concept of interest rates and delayed gratification. The parent still acts as the physical bank teller for cash withdrawals, maintaining a layer of control. Avoiding a checking account at this early stage prevents premature exposure to overdraft fees and scams, keeping the focus entirely on accumulation. For working teens aged 16 to 18, the requirements shift to an integrated model. Open a checking account alongside a high-yield savings account. Disable overdraft protection to ensure the bank simply declines any transaction that exceeds the balance. Set up an automated transfer of 20% of every deposit from checking to savings. This pay yourself first rule forces wealth accumulation without relying on adolescent willpower. Final guidance: teach your teen that peer-to-peer payments like Zelle lack purchase protection. These tools should only be used with known, trusted contacts. Building a controlled ecosystem ensures that early mistakes cost $35 rather than a teenager's entire financial future.